In the first presentation for this topic, we finished off by looking at deflation, and we finished on this slide. This slide is just really to help you appreciate the circular nature of deflation, the fact that it can actually reinforce itself, and that's part of the reason why deflation is so difficult to actually overcome, to get an economy that's experiencing deflation, to get that economy back to an inflation situation. Now, the next thing we have to look at is the difference between real and nominal interest rates. Now, most people, when they think about nominal interest rates, when they're thinking about interest rates, they're thinking about the nominal interest rate. So I've got a numerical example here, which is the easiest way of explaining the difference between nominal and real. The real interest rate is the nominal interest rate minus pi, which is the inflation rate. So the nominal interest rate is 8%. To calculate the real interest rate, we take the nominal interest rate and subtract the inflation rate, which I've got there as 3%, and that gives us a real interest rate of 5%. So what's the intuition behind this real interest rate of 5%? Because it is the real interest rate that economists believe drive investment spending, consumption spending, and lending as well. So let's just assume, let's take the case second from the bottom where we're lending money. Let's just imagine that you lend someone $1 million at 8% for 12 months. Now, at the end of the 12 months, you're going to get $1,080,000 in return. However, over the period, that 12-month period that you have loaned that $1 million to someone, the inflation rate will have been, through assumption, 3%. So even though you've got an 8% return on your lending, it's almost as if 3% of that is taken away through inflation, through higher prices. So the question is, what is the increase in your purchasing power? Well, your purchasing power has gone up by 8% because of the 8% interest rate you've received, but then it's gone down by 3% because of the higher prices, so your net increase in purchasing power is 5%. So that's the way to think about the real interest rate when you are lending money. What about when you're borrowing money? Should you be looking at the 8% or the 5%? Well, most economists would argue you should be looking at the 5% in terms of the cost of borrowing money. So how does the story go when we're dealing with borrowing money rather than lending it? Okay, it goes like this. Let's just imagine that you've gone into the bank and you've borrowed $1 million at 8%. So that means each year you have to find 8% of $1 million to pay the interest bill on that loan. However, let's also assume you earn $1 million a year in salary. Nice round numbers, large numbers, but nice round numbers. Each year, because of inflation, your salary will be going up by 3% as well. Now, if you devote a quarter or a half of your salary to repayment of this loan, then the amount of money that you are devoting to the repayment of the loan will also be going up by 3% per year as well. So it's almost as if 3% of the 8% interest that you are being charged is being covered simply because of inflation, simply because you are getting extra salary each year your salary is growing at 3% each year. So 3% of the 8% is being covered by inflation. You've got to come up with the other 5% yourself. So in that sense, you should really be thinking about the 5% interest rate when you borrow money. Let's think about a more extreme example. Let's just imagine that the nominal interest rate is 8%, but the inflation rate is 10%. Now, these numbers in reality would be almost impossible to achieve in a financial market. Let's ignore that. Just for the sake of argument, let's assume that the nominal interest rate is 8% and inflation is 10%. Well, if inflation is 10%, that means your salary is going up by 10% each year as well. So it means your salary is actually going up in percentage terms at a faster rate than the interest you're paying on your loan. So this loan should be very easy, or the interest on this loan should be very, very easy for you to cover. So in that sense, the real interest rate would be minus 2%. Now, of course, another important point for you to think about is that when inflation is higher than expected, it actually lowers the real interest rate. So if you've gone into a contract where either as a borrower or a lender where the interest rate on that particular contract is 8%, and the inflation rate turns out to be 5% rather than 3%, then the real interest rate drops to 3%. Okay, so now presumably what you would be doing in setting this 8% is working out that you want approximately a 5% real return on your money. You would look at what inflation is going to be, or the forecast of inflation over the course of the loan, let's say 3% per year. You'd add in 3% to the 5% and come up with an 8% nominal interest rate that way. So what I'm emphasizing here is that very often nominal interest rates are formed based upon not actual inflation but expected inflation. And if the expectations of inflation are wrong, then it can really affect this real interest rate. So what about deflation? How does this link to deflation? Well, I'm using the same formula here. Basically, the answer is deflation, or minus inflation, will produce a very high real interest rate. So let's assume that the nominal interest rate is 4% on a particular loan. We take off minus 3% or 3% deflation, and we get a real interest rate of 7%, which is very, very high. So deflation gives you a very high real interest rate. Now let's assume that we've got deflation and the central bank tries to lower interest rates to stimulate economic activity. Now let's assume that they can somehow push the nominal interest rate on, let's say, mortgages down to 1.5%. That's an incredibly low interest rate, but let's assume they can do it. If the deflation rate is 3%, or minus 3% for this equation, then that gives us a real interest rate of 4.5%. Now that interest rate of 4.5% is still far too high to encourage consumers and firms to borrow money and increase their spending. It would be much better if we went into an economic downturn and had not minus 3% inflation, but plus 2%. If we had plus 2%, then this formula tells us that the real interest rate at the bottom here would be minus 0.5%. Now at minus 0.5%, there is more chance that consumers and companies will actually borrow money and spend it. But with a very high real interest rate, it's going to make it very difficult for monetary policy to actually stimulate enough consumption and investment spending to get the economy out of the downturn. Okay, the next thing is the term structure of interest rates. We've seen this before in the very first topic. So we've got the demand and supply of loanable funds here, and the interest rate is set in this market at 6%. Now, first thing that we need to take note of here is that this interest rate is actually typically in financial markets, the nominal interest rate. To calculate the real interest rate, we would have to take the inflation rate away from that 6%. Now, with the market for loanable funds, someone is lending money and someone is borrowing money. Now, when that transaction, or when a transaction takes place in this market, a debt will be created. So what we're dealing with here is debt markets. Now later on in topic 6 we'll be learning about the different debt instruments such as bonds and treasury notes and bills and the nature of those different debt instruments. And those debt instruments are just the financial product that is used to facilitate the borrowing and lending process. We'll be learning more about that a bit later on. What we need to focus on now are the interest rates on this type of lending. Now, what I've got here is this notion that money can be borrowed for different lengths of time. Now, in most mature financial markets, there is a very special market that we'll be learning about later on in this topic, a special market for borrowing and lending money for 1 day. There's also markets for 30-day borrowing and lending, 90-day borrowing and lending, and 180-day borrowing and lending. Then we get up to lending of longer periods of time, such as 1 year, 3 years, right up to 30 years. There's even a market for borrowing and lending money at 100 years. That's a 100-year loan. Now, the one-day market, the market in which money is borrowed and loaned for 1 day, is called the overnight cash market. We're going to learn about that very, very soon. But just for now, I want you to appreciate that in financial markets, and we're talking about wholesale money markets here, borrowing and lending takes place for different periods of time depending upon how long lenders want to lend their money for and how long borrowers want to borrow money for. So companies such as BHP or Rio Tinto may go into the long-term debt markets and borrow money for 7 or 10 years to finance a big expansion of a mining facility. At the same time, they might enter the short-term debt market and either borrow money or lend money for 90 days. They may borrow money for 90 days just to smooth out their income flows. They may lend later on in the year, they may lend money for 180 days because they've got some excess cash for 6 months that they want to lend out and earn a return on. Then maybe after 6 months they'll take that money back and use it for something else. So companies go into different debt markets depending upon their needs. And also investors go into different debt markets depending upon their needs as well. So what we've got here are people borrowing money who are typically governments, banks and other types of companies, and we've got people who are supplying savings. Now very often that's banks on the behalf of their customers, but it can also be superannuation funds as well. Other sorts of financial organisations like that can supply money to these types of debt markets. So we've got different durations of borrowing and lending, and each one of these we have a different debt market. And so later on in this course I'll be referring to the 3-year bond market or the 3-year debt market. Sometimes I'll refer to that as 3-year money. So it's very important that you get this idea straight. Now, of course, each one of these different markets has its own interest rate, which is driven by the forces of demand and supply, as in the previous diagram. So just imagine the 1-year market, the 3-year market, the 5, 7, 10-year market. They each have a demand and supply curve, which each day is determining the equilibrium interest rate in that market. So each of these markets will have a different interest rate. So what do these interest rates look like in relation to each other? That's where we get into the term structure of interest rates. And I've got what we call a yield curve here. On the vertical, we have the yield or the interest rate of the debt. On the horizontal, we've got the term to maturity. So starting at the very left-hand side, we might have 1 day, and then we have 30 days as we move along, then 90 days, then 180 days, then 1 year. So as we move along the horizontal axis on this left-hand diagram with a normal yield curve, it's almost as if we're moving along this timeline. The period of lending is increasing. The period of lending is increasing as we move along this horizontal axis. And this suggests that with a normal yield curve, the yield curve is rising. So that means as the term of the lending increases, the interest rate payable on that borrowing actually increases as well. There's a positive relationship between the period of the borrowing and the interest rate that is applied to the borrowing. Now this yield is an annual interest rate. That's the easiest way to think about it. And these yield curves are drawn for a given day. So what this yield curve shows is on a particular day, it shows the interest rate that you would have to pay if you wanted to borrow money for anywhere from 1 day up to, say, 30 years. So that's what the yield curve is showing. Now, the normal yield curve is upward sloping, indicating that if you want to borrow money for a longer period of time, you have to pay a higher annual interest rate than if you want to borrow money for a shorter period of time. The reason for that is quite simple, and you'll read about it in more detail later on in this course, in the next topic actually. But let me just motivate the reason that the yield curve is upward sloping using a very simple example. Let's just imagine that you and I were thinking about undertaking a financial transaction where you loaned me money, and we were thinking about 2 periods of time, 1 year or 5 years, and you were going to lend me $1 million to undertake an expansion of my business. Now, if you're rational and sensible, if we go with the 5-year option, the 5-year loan rather than the 1-year loan, under the 5-year loan you should be charging me a higher annual interest rate. So this is the annual interest rate we're talking about here. That's important. You should charge me a higher interest rate each year. The reason being is that if you lend me your money for 5 years, you are taking on more risk. And the simple way I like to express it is that if you lend me money for 5 years rather than 1, I have much more time to go out of business, go bankrupt, and lose your money so that you don't get your money back. If you only lend me money for 1 year, there's less likelihood of you not getting your money back. So as you lend me money for longer periods of time, the interest rate, the annual interest rate you charge me should actually increase. Now, what we've got here is an inverted yield curve. This actually suggests that interest rates are going to fall in the future. Now, I won't go through the rationale for an inverted yield curve here. I do encourage you to do some reading on an inverted yield curve and what it actually implies about future interest rates, but it's really beyond the scope of what we're doing here at the moment. So I'll leave you with this idea of an inverted yield curve and let you look into it more in your own time. Next thing we've got to do is look at money and monetary policy, but we'll do that in the next presentation.